Welcome back to Morning Trade Live. Time now to go inside out on Netflix, and joining us now is Alicia Reese, who's the SVP Equity Research at Wedbush. A very good morning to you, Alicia. Thanks so much for joining us. You've got a $1,500 price target on this. It's at $12.30 and change right now. What gets us there?
Yeah, so Netflix has some pretty good growth that we're expecting in the back half. They don't report their subscriber numbers or ARPU anymore, but they should print some really nice revenue growth, both in terms of that subscriber growth and subscriber retention, higher price points, really great content so far in the back half, and even more coming. I think what we're going to see is that $8 billion in content spend resulting in even more free cash flow. The guide is for $8 to $8.5 billion, and I think they're positioned to surpass that pretty handily.
Okay, so you're fairly optimistic on the content, also on subscriber growth, engagement, and the ads business. I mean, is there any fly in the ointment here, or any sort of risks that you anticipate moving into the back half of the year? Because I was listening to one bull who sort of turned a little bit less optimistic on the stock, a little bit more cautious more recently, who is a little bit worried about engagement, particularly when it comes to market share from some of the competitors. What are your thoughts?
Sure. So, I mean, there's certain types of content that they're doing really well with right now. Let's take, for example, the K-pop Demon Hunters. That was the second most watched movie in their history, the most watched animated movie in their history. That just happened, within this quarter, this past month. Squid Game just hit the ball out of the park, and you have Wednesday really climbing the charts now. There's great content. I think there was a little concern that they lost the UFC contract to Paramount. Surely they were in the bidding mix, but $1.1 billion annually was probably a price that they didn't feel was worthwhile. I think their WWE content is going well, but I think they know that they can leverage their global footprint in a way that Paramount wouldn't be able to, and many of its other competitors won't be able to. They could take, international sports broadly to their international footprint and leverage that just the way they do with the Korean content, for instance. Having that global footprint and knowing what people like across that footprint really helps them in a way that their competitors just can't really touch.
Yeah, no doubt. A lot of this has been thanks to the success of some of the international content there. I just want to talk about the stock quickly because, something that's been brought to our attention and we've been discussing here at the network is this sort of pullback that we saw sort of late July, early August. We seem to have rebounded a bit, but not recovered as much to the highs that we were looking at sort of mid-July. And there seemed to be a bit of head scratching going on. Just because of the fact that it had reported good earnings. And I'm just wondering what you read into that.
Yeah, so I think there was just shifting around with different names in not just the sector, but in tech generally. It's a really rich valuation, so they do have to impress increasingly. And what needs to start working in a meaningful way is their ad-supported program and their ad revenue. They're not giving out this information, so it's a bit of a black box at the moment. But what we saw in the last printed quarter was that people, especially some survey work that we did, indicated this, that a lot of the users went back to the premium tiers because the content that they wanted to consume, it worked for that. Now, if they can really increase the ad revenue, and they're targeting doubling the ad revenue this year, that will set them up very well for next year and beyond, just running on ad revenue as their primary growth driver. Right now, the primary growth driver is what they're getting from increasing the subscription price, and that's worked very well for them. There's been very little pushback from what we can tell, given their results and given our survey work. And so that next leg of growth is really ad supported. So they have to show that. That's a proof point.
Right. So they do still need to prove on that. I mean, certainly as far as the subscriber growth continuing, to your point, which you've highlighted in your notes, I mean, consumers have absorbed the price increases, and that's come with little resistance. And, time and time again, when we talk about these trends, I mean, people sort of still continue to hang on to their subscriptions, even if, there's been nothing coming down the pipeline as far as new content, just in hope that, obviously it will. Just your last thought on, something that I've been paying attention to, and this is this sort of headline, it's a suggestion that, with regards to the streaming wars, Netflix is seen as having won that, but there's also a bit of a suggestion that it wants to be a bit more like a Walt Disney in terms of an entertainment conglomerate. Now, that's been seen as maybe a big part in what keeps it, pushing higher if it can pull that off. What are your thoughts on that whole view?
Right. So they're very early on in this venture. They do some, consumer-facing events where, people can go enjoy their content. But, they're doing some interesting things. They have, a little bit of, dipping their toes into theatrical. They're putting K-pop Demon Hunters in the theatrical screens next weekend for 2 days, just for sing-along for the K-pop Demon Hunters. They have Narnia going exclusively to theaters next year on IMAX screens. So I think they're dipping their toes in theatrical. They would need to go quite a bit deeper to rival the likes of Disney. That's a very profitable portion of its content business, streaming secondary. And then you have, obviously parks, which they're not there yet. They do have some, consumer-facing pieces, but they have a long way to go. And then merchandising, they have a long way to go there. But, they're continuing to churn out some really great IP that could eventually drive that to be more meaningful. Lastly, they have their games, which Disney has generally failed at over the years, and they're doing quite well. They're doing it in a very methodical and careful, cautious way, and it's worked so far for them, and I think they can expand that pretty meaningfully over time.
Yeah, and I think a lot of those on the street there are wanting to see what they can sort of, I suppose, prove on as far as some of the live content is concerned, particularly because we're going to get some more evidence of that, particularly off the back of the Taylor Serrano boxing match, which happened in July in the next earnings report. Yeah, so obviously that's key too.
Right.
Alicia, it's been a pleasure talking to you. Thank you so much for your time. Really appreciate it. Alicia Reese of Wedbush joining us there. Let's trade it now with Tom White, who is the host of Fast Market. And let's start with your bullish example trade. Good morning, Tom.
Hey, Sam. Yeah, implied volatility levels really, muted at this point. IV percentile rank below 10%. So we're in the bottom 10% of what we've seen implied volatility levels over the past 52 weeks. So I looked at a strategy that's bullish, kind of setting up with your guest theory here that the $1,500 price target. But I went out in duration a little bit. I went out to the September monthly options, about 37 days till expiration on this one. So you've got some time, over 5 weeks in this. And I'm going to buy the slightly in the money 12.20 strike call, and then against it to offset some of the risks on that, because there's still a lot of extrinsic option premium in those calls that you're buying. Sell the 1300 strike call. So an $80 wide bullish call vertical to the upside. We sometimes call this a big boy vertical because you're paying quite a bit for it, right? You're paying a $33.50 debit for it. So you've got $3,350 in risk on this position. But it takes your break even on this one up to $12.5350 over the next 5 weeks. And that's only about 2.5% above the current share price. So it's not like you need a massive move to the upside to get to that profitability on the break even. And then all the way to 1,300, still only about 6% above the current share price in there. So like I said, over a 5-week period, you don't have that much on a percentage basis to go. Remember, the all-time high is above that 1341 level that we saw in June. So it's still below those all-time highs. And the key in with this type of directional biased strategy is, even though I've got 37 days till expiration, I've got some flexibility as far as trade management goes, right? I don't have to wait until expiration to close all or a portion of this vertical. If I get that move that's needed above that 12.5350 break even, say this thing starts to expand to $45, $50 on an $80 wide call vertical, that gives me some options to close a portion of it or all of it early. So yeah, you don't need a big move to the upside on this one due to that low implied volatility that lowers the input costs on a directional vertical like this.
Okay, and talk us through a more sort of neutral example trade on this one.
Yeah, a little bit more conservative, but it flips the risk-reward profile on this. On the previous long call vertical, you're risking 33.50 to make 46.50. On this one, I'm using better probabilities of success on it and a shorter duration. So on this one, a short neutral to bullish put vertical, I went out to the August 29th weekly cycle here, so just about 16 days to expiration. And I sold the 11.95 strike put and then bought against it because we want to stay risk defined, bought the 11.75 strike put. So a short $20 wide, neutral to bullish put vertical. I'm going to collect roughly about a $4 credit on it. That's what I can make, $400 per spread. I've got $1,600 in risk, but it does take my break even down to 11.91 to the downside on this one, and that's about 3% below the current share price. The probability of that short 11.95 strike put that I'm selling in this strategy, I've got about a 68% probability that that will finish out of the money at expiration, which is what you want. When you sell a put vertical like this, the idea is over the next 2.5 weeks, it stays above 11.95, and I just get to keep that credit that I collected on this one. Break even 11.91. You got a big 3% cushion to the downside before you start getting hurt on this one, Sam.
All right, Tom White with a good look at Netflix there and his example trades. Thank you so much. Really appreciate your time there, Tom.